Hey everybody, so in this video we're going to talk about deep in the money covered call strategy. Now, I made a video on this in the past, but I just wanted to do a newer version of this that's a little bit more comprehensive with fewer mistakes. So in this video, I'm assuming that most of you understand how to buy and sell options, but you're just looking for more strategy. Now, if that's not the case, I strongly suggest that you guys watch my video covering the options Greeks. And I'm going to go ahead and link that down below. Now, just jumping straight into this, here's the scenario. We're looking at SPY, which is the S&P 500 tradable ETF. And the reason why I like doing this with SPY or QQQ or any other big mega cap stock is because there's a lot of liquidity in the options. And generally, these are things that you would actually want to hold. So if you're to do this with a less popular stock that has like a possibility of going bankrupt, well then, any strike that you sell at, it could significantly fall below that and you could pretty much lose all your value. And you would just get this safe sense of safety just from selling these covered calls. And you don't want to do that. So I recommend you sell covered calls on very safe stocks that you're essentially just looking to target a certain return on investment. So you should be okay with selling this, or you should be okay with keeping this. So, either situation, whatever happens, you're okay with it. So that's essentially the basic principle that you should have in your mind when you're doing this strategy. So let's just go right into it. So in this scenario, we're looking at SPY. Let's just look at 425. Forget the change right there. So we're just pretending that SPY is at 425. We want to sell a covered call with a 1-year time period. So right now, it is October 2nd, 2023. And the contract that I'm looking at is September 30th, 2024. And if we want it to be deep in the money, it needs to be far below the actual market price. So right now, 425, we're looking at a strike price of 330. Now, we want to be conservative. So instead of looking at the ask, we're going to look at the bid. Realistically, we're probably going to get something in between the ask and the bid. But just for conservative sakes, we're looking at the bid right here, which is $113.48 per share. So we have to remember that one contract is 100 shares. So this is actually $11,348. So let's just define this contract in words. So this is how the contract reads. If SPY is over $330, by September 30th, 2024, I will sell 100 shares of SPY at $330. At the time of selling this contract, which will be today if I sold it, I receive $11,348 immediately. So essentially, you can see that your sale price is going to be that $33,000, which you're going to sell it at in September 30th, 2024, if it's over 330, and the $11,348 of premium that you receive immediately. So if we combine those two numbers together, that's going to give us $44,438. So your share basis is $425 per share, or a net total of $42,500. So this is what's going to show up on your brokerage account. $425 per share. That is how they actually calculate your tax. If you sell for anything below this, that is a loss on your tax. If you sell anything above this, that is a gain on your tax. Now, let's look at this. So what would our profit be? Our profit would be $1,962 if everything goes accordingly. So how did I calculate that? That's essentially the difference between our sale price and our basis, which would be $42,500 total if we're doing 425 times 100 shares. So, we're going to receive $11,348 back as premium when we sell the contract. So what did we actually invest? We actually invested $31,152. So our imaginary basis, which we're just going to put on our books, is going to be $311.52. So this is very, very important. You need to know this. Your brokerage account is going to state that 425 is your basis. But in your head, in your books, you know that it's going to be 311.52 because you got that 11,348 back. But when you're actually taxed, you're being taxed based off this 425 basis. So this right here, that $11,348, that's just all profit right there. So you're essentially just realizing your profits right away ahead of time. So that is the downside here. So yeah, you have to think about that on a tax basis. So always keep that in the back of your mind. Now moving on, if you're holding 100 shares of SPY for 1 year, you are essentially going to get $651 in dividends. So that is 4 quarterly payments. And it's not always 651. It's roughly around that. So it could be around, it's generally around $600 plus. So what is your return on investment as a percentage? So that's going to be $651 in dividends plus that $1,962 in profit. And then you're going to divide that by your actual investment, which is that $31,152. So that's going to yield you 8.33%. Now, don't forget that the $11,348 is uninvested. So you can invest this however you want. But regardless, you still need that $42,500 to initiate this contract. So if I had $31,152, I couldn't initiate this contract because I would need to buy 100 shares first. So you still need that $42,500 to get that contract because you need to buy the 100 shares. But what you're actually investing is $31,152 because you're getting that premium back. So I hope that makes sense. And if it doesn't, just go over it as many times as you need to. And now we're going to talk about the risk because there's always risk. So let's say by expiration, we close below the strike price. How much coverage do I have? So I bought the shares at $425 and premium is $113.48, which is effectively covering me until SPY falls to $311.52. If SPY falls under $311.52, my insurance, which was the premium, is gone. And I have an unrealized loss at that point because my shares are not assigned. So remember, for your shares to be assigned and called away, it has to be over 330. If it's even 1 cent below that, you essentially just keep your shares and the contract expires worthless and you pocket that $11,348 of premium in full. So what happens if your shares close between $311.52 to $329.99? Well, you actually profit without being assigned. So that $311.52 is your break even. 1 cent below that is a loss. But at $311.52, if the share prices close at $311.52 on September 30th, 2024, you have essentially broken even while holding the shares for 1 year. But you're still going to receive those dividends. So this break even is not considering that 651 dividend. So what if my shares close at $355 by expiration? It doesn't matter because the contract specifies you sell at $330 if it's above $330. And what if my shares close at $500 by expiration? Well, it sucks to suck. You still have to sell it at $330. That's the risk. That's the FOMO risk. Now, one last thing to remember. We can always receive safe interest through bonds or bank savings account. So if we're going to get it through bonds, that would be like 5%-ish, maybe a little bit more, and we could lock that in. If we're going through a bank savings account, maybe we could get like 4.5 or whatever, but it's going to fluctuate if the interest rates change. So you always have to think, if you can't get over 5%, you're losing money because you could have got 5% safely somewhere else. So always, always, always think about that. So what am I getting in premium by doing this? If I could have got 5% doing absolutely nothing in a safe manner, well, I'm essentially getting that 3.33% extra from doing this. And you have to think about what is the risk of this. So if we're looking at the strike 330, that's very conservative. That's essentially saying, hey, you know what? SPY would have to drop about, $95 from where it is right now. That's a lot. That's over a 20% crash. So this is more of a conservative approach. And well, what happens if SPY closes below that well then now I just pocketed all that premium, and now I have shares at a pretty low imaginary basis. And I have to constantly specify this imaginary basis because you know that you pocketed that premium. So essentially, that basis is gone down, but that's not how it's reported in tax matters. In tax matters, it still records that you own those shares at 425 per share. So even if you know that your basis is actually 311.52, if you were to sell it at 350 or something like that, you would still record a loss because your brokerage account knows that your shares were purchased at 425. So you always got to think about this stuff in the background. So essentially, like I said, that premium is all taxed. So that's something you really, really got to think about. Now let's look at scenario 2. Scenario 2, we're taking more risk. So we're going to pick a higher strike, and we're going to assess how this actually works out, and how much more benefit we're going to get, and is the risk reward actually worth it? So let's go ahead and take a look at this. So here's how we define this contract. If SPY is over 380 by September 30th of 2024, I will sell 100 shares of SPY at 380. At the time of selling this contract, I received $7,224 immediately. So notice right here that the premium is less. Why is the premium less? That's because the strike price is higher. So if the strike price is higher, that means that I sell it at this price. So I'm going to get more money. Therefore, to offset that, the premium has to be lower. So that's essentially how that all works out. So essentially you can see that the sale price is $38,000, which is the strike price times 100, plus $7,224, which is my premium, times 100, or $45,224. So that is essentially my net sales price. Now, if your share bases are $425 per share, that's going to be a net total of $42,500 that you need to invest to initiate this contract. So profit is $2,724 or $2,724 if everything goes accordingly. What do I mean by that? That means if SPY is over $380 by September 30th, 2024, you're going to make $2,724 off this initial contract right here. So you received that $7,224 back as premium when you sold that contract. So what you actually invested, this is the book investment, the one that you're writing down in your books, that's that imaginary amount. You invested $35,276. And if we're looking at that as a per share basis, that's $352.76. Now remember, like I said, your brokerage account is going to record that as $425 per share when you know that actually you received that premium and your shares are pretty much more like $352.76. So in between this, you're going to receive $651 in dividend, or roughly around that amount. So what is your return on investment as a percentage? It's $651 plus the $2,724 in profit divided by $35,276, which is that actual amount invested. And that comes out to 9.57%. So if we're looking at scenario 1, that was 8.33%. Now we're looking at 9.57%. But we're taking significantly more risk because 380 is a lot closer to 425 than 330 is to 425. So here we're taking significantly more risk for maybe just like 1.44% more. So is it really worth it? That's what you have to ask yourself. Now, don't forget that you also have that $7,224 that is uninvested. So invest this however you want, but regardless, you still need that $42,500 to initiate that contract. So what is the risk? It's very similar like before. You're going to realize that when you keep doing this, you're essentially going to follow this template. So the risk, let's say by expiration, we close below the strike price. How much coverage do I have? So I bought the shares at $425 each. The premium is $72.24 per share. So that effectively covers me until SPY falls to $352.76. That is my break even. So if SPY falls under my break even, I'm going to have an unrealized loss because my shares are not going to be assigned. And I'm just going to pocket the premium and I'm going to get my 100 shares back at whatever price is the current market price. Now, if the contract closes, or if shares close between $352.76 to $379.99, I actually profit without being assigned. Because like I said, $352.76 is my break even. Now, also remember, we can receive safe interest somewhere else, bonds, bank savings rate, whatever. So we have to make sure that whatever we're getting is above 5%. If we got above 5%, we did good. But we also want to minimize our risk. So the big question here is, we substantially increased our risk by increasing the strike from 330 to 380. And by doing that, we essentially increased our return on investment by about 1.24%. So is it worth it? Is that 1.24% worth all of this extra risk? So my personal opinion, it really depends on your risk tolerance, but I wouldn't risk it. I think the 330 is a lot more conservative, a lot safer, and it's a lot more defined. So scenario 3, this will be your homework. So go ahead and just write down in the comment section what you actually came up with as your return on investment using a 395 strike with that premium. And then same with scenario 4. I want you to go ahead and do this for scenario 4. Go ahead, post the answers. Hopefully other people are doing this too and you guys can compare answers. Or if not, I could do a quick calculation, respond to your reply, tell you if you're right or if you're wrong. Now, other things that you want to keep into consideration, you want to look at the charts. What are the charts doing? So if I'm just looking at SPY, I just did a quick Fibonacci retracement. So I'm looking at this movement right here. So this right here is one massive down movement to me. And what we're starting right now is this new uptrend right here. So, I'm taking a fib retracement from the high right there to the low right there. So price action is pretty much moving between 347 to around 478, which is a pretty big range. But in between here, we have these fib retracement levels, which act as support. And we have to pay attention to what is the mid. So if we're looking at the mid, that's around 413. And if we're actually looking at where is price moving the most, so just by looking at it, you can see price is pretty much moving right between here the most. So this range, that's somewhere in between 378 to 413. So you need to think about this in the background when you're determining your strike. So if I'm picking a strike of 330, which is below this low fib line, which is the low that we made in 2022, that would be, in my opinion, a rather safe assumption that you're going to get assigned. So your rate of return is a lot more defined because you're assuming that there's a high probability that you're going to get assigned because your strike price is even lower than the lows that we made in a very bad year, which was 2022. So what if I sold the call at 478, which was the high that was around, I believe it was early 2022. So that would be a lot less likely, and I'm pretty sure the premiums would be much lower. So these are some things that you need to think about. So, what if I pick something in between this range right here, that 378 to 413? What if I picked a premium, or what if I picked a strike in between that range? Well, there's a lot more variability because there's a good likelihood that price might actually close around that time, assuming that what we're in right now is a longer term correctionary phase through time. So there's a lot of variables that you need to think about. So maybe right now, maybe we're going to be in a correction through time and this is going to last several years and we just move in this predictable range between maybe like 347 to 478. And we don't necessarily make a new high this year. Maybe the end of 2023 is not higher than 478. So that would essentially be saying that for the year of 2023, we made a lower high. So these are things that you need to think about. Is 2024 going to be more fruitful? Are we going to surpass that 478, or are we still going to stay within this range? Because if we still stay within that range, then that can essentially be seen as a correction through time. So a lot of different variables that you got to think about here. Now, here's chart number 2. This chart is looking at RSI on a weekly time frame. So this means that one candlestick is 1 week. So why am I looking at the weekly time frame, not the daily time frame? That's because the weekly time frame is better if we're investing for a longer period of time, which is 1 year. So if we're thinking about this in quarters, if we're just going to do like 2 quarters or something, and we're just going to do a covered call contract for 2 quarters, well then maybe the daily RSI will be better. And generally when you sell a covered call, that is a short position. So you're being bearish. So you would want to sell this when the RSI is high. So high RSI on the weekly time frame, that would be like 70. So 70 would basically be saying, hey, you know what, we're a little bit overbought here. We're a little bit overextended. 30 would be low RSI. That would be like, hey, we're oversold. We're deeply, deeply oversold. So if you look at these lines in green, these green vertical lines, this is when RSI was over 70. So right here, you know, quickly we saw a downturn. Right here, we saw a downturn or some sideways action and then a downturn. And then right here, another downturn. So this is why it's beneficial to be selling covered calls when RSI is high, when weekly RSI is high, like 70 plus or close to 70. If it's somewhere neutral, like 45 or 50, that's okay too, as long as you know that your risk reward is defined. You know that, hey, you know what, the likelihood of me receiving like an 8.33% return on investment is pretty darn high. Then hey, you know what, forget about the RSI, just do whatever you want. Now, on the flip side, you would not want to sell a covered call when RSI is around 30 because there's a good chance that it could just rebound. So if we're looking right around here when weekly RSI was around 30 and right around there when weekly RSI was close to 30, you can see that we are very close to the yearly bottoms. So these are not good areas to be selling covered calls. You would want to be selling covered calls when RSI on the weekly is much, much higher. So just some extra things that you want to pay attention to. I know there's a lot of things that you want to pay attention to, but definitely take into consideration your premiums, your return on investment, the timing in terms of charts, and where you would want to set those strikes based off of your supports. Now, let's go over some frequently asked questions. So question number 1, how do I sell calls? Well, first you need to contact your broker and you need to get approval to buy and sell options. So there's different levels to this. It's going to be like level 1, level 2, level 3, whatever. And just pretty much tell them, hey, you know what, I want to have access to sell calls. And then they'll give you the appropriate access. Now, question number 2, okay, I set up the options on my brokerage and I bought 100 shares. What now? So on your brokerage, you know, there should be an options tab next to your purchasing shares tab. And you're going to want to do an action that's called sell to open. So when you sell to open, you're essentially opening this contract. You're selling this contract and you're waiting for that contract to get filled. So let's go back in scenario 1. So if I'm going back to scenario 1 and I were to sell this contract, so let's say I picked the 330 strike for September 30th, 2024. So what I am doing here is that I am selling to open a call contract at the 330 strike that expires on September 30th, 2024, and I am selling this at bid. So I am selling this at $113.48. So that's essentially $11,348 if we multiply that by 100 because one contract is 100 shares. So when I do this, and let's say somebody purchases it immediately. So right here, you can see that there are 50 bid orders right here. So there are 50 people bidding for this contract right there. So if I set it at the bid, it is going to be sold immediately. So then once I sell to open, you're going to see that that contract got filled and then it's going to show up on your dashboard. So that is essentially how you sell a contract. Now, if you wanted to close that same contract, you would have to sell to close. So when you sell to close, or actually, scratch that. You would want to buy to close. So to actually close a covered call contract, you would need to buy a call with the same strike, with the same expiration. So you have to think about it like this. Initially, you sold the contract. So to close the contract, you need to buy the contract back. And that would essentially net it out to eliminate that contract. So once you eliminate that contract, you get your 100 shares back. And they're not locked anymore. So that's what happens there. So let's go back to the FAQs. So why is it showing a loss on my contract on my account dashboard? So once you purchase that, or once you sell that contract, it's going to show up right underneath your SPY. So you're going to have 100 shares of SPY that show up. Right below that, there's going to be that covered call contract with the strike price, with the expiration, with the current market premium, and the actual premium that you received when you sold it. So, if you're looking at a loss on that contract, what that means is that from the time that you sold the contract to the current time that you're looking at it, the market price for that contract has fluctuated. So for instance, if SPY was 425 and I sold a covered call for the 330 strike, then let's say the next day SPY goes up. It goes up to 430. Well, then what happened? Now it's going to be cheaper to repurchase that same exact contract, because remember, when I am selling a covered call, this is a shorting strategy. So if the share price goes down, the contract value goes up. And then the inverse happens if the share price goes up. So if the share price goes up, the contract value goes down. So it's actually cheaper to purchase the contract back. So essentially, if I wanted to close out that position at that time, rather than waiting till the expiration, it will cost me more to purchase it back. So therefore, I would be taking a loss. But if I actually just hold the contract to expiration, then that contract holds true. So, if we're looking at scenario 1, and I just hold this to expiration, then essentially no matter what the price is, if it's over 330, I sell it at 330 and I receive the premium already. So no matter what, I have to sell it at 330 if it's over 330. And that's not necessarily the scenario if I want to close out the contract and I want to buy it back. So that is where some fluctuations will happen. So ultimately, if you plan to stick with the contract and you're not going to close it out early, just ignore whatever fluctuations you see there. Now, why is it showing a gain on my contract on my account dashboard? Well, I just covered that. So that's essentially if the share price goes down right after you sold the contract, then you would essentially see a gain on that contract. Or if, let's say, I sold the contract when SPY was 425, but 1 month later SPY is still 425, well then my contract is actually cheaper to repurchase, because by that time there's something called theta, which is the loss of value over time of the contract. Now, if you don't know what theta is, remember I have a video talking about the options Greeks that's linked down below, so definitely check that out. Now, here's another common question. Can someone exercise my contract and my shares get called away? Well, yes, that is a possibility, but usually it's less likely to happen with large ETFs or mega cap stocks. Now, you have to remember, if somebody is going to exercise their call contract, they need to have the motivation to do so. So if you get exercised early, that's not a bad thing, because that essentially means that you're selling at 330, you already got your premium. So you're just selling the shares at 330 early. So it doesn't necessarily matter a whole lot. Now, what matters is if you got exercised early, you might miss out on maybe 1 dividend or 2 dividend cycles or what have you. But essentially, you will receive that $330 per share when you get exercised. So it's not a big deal. It's not that much of a big deal. It's not like you're going to get any less. You're still going to get that 330 if we're going off scenario 1, and you already got the premium. So the initial scenario still plays out. The only difference is the dividends. So I hope this video was helpful to you guys. Definitely check out some of my other videos on options, and I hope you guys enjoyed it.